Welcome back to the deep dive. We've got a really fascinating one for you today. Usually when we talk about precious metals, the conversation just immediately goes to gold.
Right, the safe haven.
Exactly. Gold is the celebrity of the metal world. It's the store of value, the jewelry on your finger, the bars in Fort Knox. And silver. Silver is usually just, well, the runner-up.
The participation trophy of commodities. Poor man's gold, I think, is the phrase people have used for a century.
Right. But today, we are flipping that narrative completely upside down. We have a stack of reports here, specifically a breaking analysis from Doug Young. It's actually dated for tomorrow, February 20th, 2026. So we are right on the bleeding edge of this.
And the picture this report paints is, well, it's tense. That's the best word for it.
Yeah, if you think silver is just about earrings and old coins, you are missing the absolute biggest story in the global economy right now.
Tense is honestly putting it mildly. If you look at the data we have in front of us, silver isn't really behaving like a precious metal anymore.
Not at all.
It is behaving like a strategic industrial utility, one that is rapidly running out. It's effectively the invisible nervous system of the modern world, and right now, that nervous system is flashing red.
So our mission for this deep dive is to unpack this report, which is titled Physical Demand Reshapes Silver Market Dynamics. We are looking at a predicted deficit of 67 million ounces for this year alone.
Just this year.
Which is wild. And we need to figure out why the vaults in New York are bleeding inventory at record speeds, and why, for the first time in a long time, the price on your screen might not actually match the reality of getting the metal in your hand.
It's a classic collision between physical reality and financial markets, but there is a massive geopolitical twist to this that we really need to dig into.
Okay, let's unpack this. Let's start with the demand side, because I think this is where most people, myself included, get stuck in that old jewelry mindset.
Yeah, it's a common trap.
The report explicitly calls silver a utility. Why? What is so special about this specific element that we can't just swap it out for something else?
It honestly comes down to physics. Pure and simple. Silver is the single most conductive metal in existence.
Period.
Period. It moves electrons better than copper, it's better than gold, better than aluminum. If you want to move electricity efficiently, you want silver.
So it's literally the path of least resistance.
Literally. And think about the world you and I are living in right now, in early 2026. Everything is becoming electrified.
Right.
Everything is becoming digital. And the absolute backbone of that transition is silver. It's not about vanity anymore. It's about performance.
Well, the report throws out a number that honestly shocked me. It says the solar industry, just solar alone, is projected to consume over 200 million ounces this year.
Right, 200 million. And to give you some context on that, that is roughly 20% of the entire global supply swallowed by just one single industry.
That is massive.
And it's not just the sheer volume, it's the necessity of it. Every single photovoltaic solar panel on a roof or out in one of those massive desert farms requires silver paste.
How much are we talking per panel?
We're talking roughly 20 grams per panel just to conduct the energy from the sun into the grid. And with the record installations we are seeing globally this year, that demand is entirely non-negotiable.
Okay, but here is where I have to play devil's advocate for a second.
Yeah.
Let's say I'm the guy looking at the factory budget. If silver gets too expensive, can't these manufacturers just use copper? I mean, copper conducts electricity pretty well, and it's a lot cheaper.
Why not just switch, right? That is the big question. And honestly, some manufacturers, particularly over in China, have tried to shift to copper to cut costs. But there is a massive penalty.
What's the penalty?
You lose efficiency. When you are building a solar farm, the entire game is efficiency. You are fighting for every tiny fraction of a % of power generation.
So if you use copper, you just get less juice?
You get less power, and you also deal with corrosion issues that you just don't get with silver.
Right.
If your panel produces even 2% less power because you cheaped out and used copper, that kills your profit margin over the 20-year life of the farm.
Oh, wow.
Yeah, so despite the upfront cost, they stick with silver. It's what analysts call sticky demand.
Sticky demand, meaning they can't easily switch away from it. Okay, that makes total sense for solar. But Doug Young's report says it's not just green energy driving this. It mentions AI and data centers. Now, I don't usually associate artificial intelligence with a shiny metal. I think of chips and software.
Sure.
What's the physical connection there?
Well, you have to ask yourself what runs the software.
Massive data centers.
Exactly. Servers that run incredibly hot and need to be 100% reliable. We are building these billion-dollar AI training clusters now. When a tech company is building infrastructure that expensive, they are prioritizing performance over price.
Right, you're not going to cheap out on the wiring for a billion-dollar supercomputer.
You absolutely aren't going to risk a failure in a circuit connector or lose processing speed just to save a few cents by using a cheaper metal. You need the absolute best conductor to manage the heat and the speed. So silver is deeply embedded in the high-end semiconductors, the 5G networks, the EV control systems.
So you have these massive, distinct industries, green energy, AI, EVs, and they are all fighting for the exact same pile of metal.
And we can't forget the defense angle here either.
Oh, right, the critical mineral designation.
Yes. The U.S. government lists silver as a critical mineral. It's in radar systems, it's in the guidance chips for missiles, military communications. So now you have a situation where urgent national security needs are actively competing with your new solar panel and your new AI chatbot.
Which sounds like a total recipe for a massive shortage.
Yeah.
And this actually leads me directly to the supply side. This is the part of the deep dive that always confuses me about commodities.
Let's hear it.
I'm looking at the price of silver, and sure, it's volatile, but it's generally trending up. If the world needs so much of this stuff, why aren't the mining companies just going out and digging more holes?
That's the logical assumption, isn't it? Economics 101. High demand equals higher price, which equals more supply.
Right. If people suddenly want way more apples, farmers plant more apple trees.
But silver breaks Economics 101 because of something called the byproduct quirk.
The byproduct quirk. That sounds like a sci-fi novel. Explain that to me.
Okay, let's use an analogy. Imagine you run a bakery, and your main business is selling donuts.
Okay, I'm with you.
But every time you make a batch of donuts, you end up with a tiny bit of leftover dough that you bake into a single donut hole. You sell the donut holes, sure, it's nice extra cash.
Right.
But you don't bake an entire batch of large donuts just because someone wants more donut holes. You bake for the donuts.
So in this mining analogy, the copper is the donut.
Exactly. Roughly 75%, three-quarters of all the silver produced in the entire world is essentially accidental. It's a byproduct of mining for copper, lead, or zinc.
That is wild to me. I always just assumed there were these dedicated silver mines everywhere.
There are very few pure silver mines. They are geologically quite rare. So here is the core problem. If the price of silver suddenly doubles, but the price of copper stays flat, a major copper miner is not going to dig up thousands of tons of extra earth. They are chasing the copper.
They don't care enough about the silver bonus to change their massive multi-million-dollar operations.
Precisely.
So the supply of silver is, what's the economic term?
Inelastic.
Highly inelastic. The price of silver can scream higher, but the actual mine supply won't budge, and the data in the report proves it. Global mine supply has been totally stuck at around 800 to 830 million ounces a year for a decade.
It's just completely flat.
It hasn't grown at all, despite the solar boom, despite the AI boom.
And I imagine you can't just spin up a new mine overnight either.
Oh, no. It takes maybe 10 years to permit and build a mine. So even if we found the greatest pure silver deposit on Earth today, it wouldn't actually help us until the mid-2030s.
Okay, what about recycling? I know I've got a drawer full of old iPhones at home. Surely we can melt those down. We do recycle. It adds about 180 million ounces a year.
That's something.
It is, but think about how physically hard it is to get a microscopic bit of silver out of a crushed iPhone. It's expensive, it's energy intensive, and the process is difficult. So recycling helps, but it's capped. It cannot scale up fast enough to suddenly meet a 200 million ounce solar demand.
So let's just do the back of the napkin math here. We have demand exploding because of the energy transition and AI.
Yeah.
We have supply that is geologically and economically stuck. And Doug Young's report says we are looking at a 67 million ounce deficit for 2026.
And remember, that is just this year. This is the 6th year in a row we've been operating in a deficit.
6 years.
Since 2021, the world has consumed about 300 million ounces more than it has actually produced.
Okay, wait, pause. If we have been using more than we dig up for 6 straight years, how are we not totally out? Where is this phantom silver coming from?
It comes from the stockpiles, the above-ground vaults. Think of it exactly like a savings account. We have been spending more than we earn every month, so we are draining the savings. But right now, in 2026, those savings are getting dangerously low.
And this brings us to what I think is the most dramatic part of this entire analysis, the vaults. Specifically the COMEX in New York.
Yes. The CME Group's commodity exchange. This is the absolute heart of the Western silver market. It's where the global benchmark price is set.
So walk us through the drama happening there. The report mentions two categories of silver in these vaults, eligible and registered. And I feel like these financial terms are designed to be confusing on purpose.
They are a bit inside baseball, but the distinction is absolutely critical to understanding the shortage. Let's simplify it. Imagine a giant high-security warehouse. Eligible silver is like a classic car parked in a private, locked garage inside that warehouse. It meets all the purity standards, it's safely in the vault, but it is strictly not for sale. It belongs to someone, maybe a bank, a private investor, a family office, who is simply paying storage fees.
Got it.
Yeah.
So it's physically sitting there, but the market can't touch it. It's totally off limits.
Right. Now, registered silver, on the other hand, is the inventory sitting out on the showroom floor. It has a specific warrant attached to it. It is available for immediate delivery to settle a trading contract. This is the buffer for the entire market. If you buy a futures contract and demand the physical metal, this is the pile they have to take it from.
And what exactly is happening to that showroom pile right now?
It is vanishing. The report highlights that on February 11th, 2026, the registered inventories dropped below 100 million ounces. It actually hit a low near 98 million.
Okay, is 98 million a lot? Because to an average person, that sounds like a massive mountain of metal.
It sounds like a lot until you compare it to the paper market. And this is where the system gets really risky. The COMEX is primarily a paper market. People trade futures contracts, which are essentially financial bets on what the price will be, without ever intending to touch a real bar of silver.
Right, they're just speculating. They buy the paper contract, the price moves up, they sell the contract, and they take the cash profit. No armored trucks involved.
Precisely. That's how it usually works. But the whole system relies on confidence. There is a ratio we look at, open interest versus registered stock. Open interest is the total number of active paper contracts out there. Right now, that's hovering between 130,000 and 150,000 contracts.
Okay, let me do some mental math so we can see the scale of this. One contract is usually 5,000 ounces, right?
Correct. 5,000 ounces per contract.
So 130,000 contracts times 5,000 ounces. That is roughly 650 million ounces of paper claims.
Exactly. Versus only 98 million ounces of actual deliverable registered silver sitting on the showroom floor.
Wow. That is an insane amount of leverage.
Yeah.
There are like 6 or 7 people holding a paper claim for every 1 ounce of real metal that's actually available to give them.
It's a giant game of musical chairs. As long as the music plays and everyone is happy trading paper and just taking cash profits, the system works fine, the music keeps playing. But the report points out that the music is starting to stutter. We're seeing a huge surge in what they call stand for delivery notices.
Meaning the traders aren't taking the cash settlement anymore. They want the actual metal.
Exactly. Market behavior is fundamentally changing. Traders are moving from speculating on press to securing the physical asset. They see the exact same deficits we were talking about. They see the massive solar demand. They see the miners not producing more. And they're saying, you know what? I don't trust the paper promise anymore. Put the metal on a truck and give me the physical bar.
And if even a relatively small percentage of those paper holders demand delivery all at once, that 98 million ounce vault hits zero incredibly fast.
Correct. You can't just print silver like you print money. If they want the metal and it's physically not there, the whole system jams up.
Okay, and if that wasn't complicated enough, we have to bring in the geopolitical angle, the China factor.
Yeah.
Because it seems like every time we look at supply chains lately, all roads lead right back to Beijing. Is this shortage just a New York COMEX problem?
Not at all, and this is a crucial piece of the puzzle. China is actually the giant vacuum cleaner that is causing the shortage over in New York. You have to remember, China completely dominates the processing side of this. They currently control over 40% of the global silver refining capacity.
Okay, so they dig up the ore, or they import it, they refine it into pure industrial bars, and then what?
Well, historically, they would export a ton of that fabricated silver out to the rest of the world. But as of early 2026, the report notes a massive state policy shift. They're keeping it.
Keeping all of it.
They have drastically reduced exports to prioritize their own domestic manufacturing, their own solar panels, their own EVs, their own grid upgrades.
So it's strategic hoarding.
Effectively, yes. They clearly see silver as a strategic asset vital for their industrial dominance. But here is the actual mechanism that is aggressively draining the West: the price disconnect. Right now, silver on the Shanghai Gold Exchange is trading at a premium of more than $10 per ounce over the COMEX price in New York.
Wait, $10? That's a huge gap. If silver is, say, $35 an ounce in New York, it's $45 in Shanghai.
Roughly, yes. So just put yourself in the shoes of an international silver trader or a refiner. You have a pallet of silver bars sitting in a vault in London or Zurich. Do you sell it in New York for 35, or do you put it on a ship to Shanghai and make an immediate extra $10 an ounce?
You ship it to Shanghai.
Yeah.
Immediately. It's literal free money.
And that is exactly what is happening in the real world. We are seeing a massive physical arbitrage. The physical metal is flowing rapidly from west to east to chase that higher real industrial price. This is draining the Western vaults like the COMEX even faster than domestic demand alone would.
It honestly feels like the market mechanism is breaking. Like the New York price is kind of fake because it's based on paper trading leverage, and the Shanghai price is the real price because it's based on actual desperate industrial need.
That is the exact argument many top experts are making right now. The West is still pricing silver like a traditional financial asset, just a line on a screen that goes up and down based on interest rates. The East is pricing it like a critical industrial ingredient that their factories literally cannot operate without. And history shows us the physical market always wins in the end.
So what happens when the rubber finally meets the road here? Or I guess when the paper meets the metal? If the COMEX vaults drop too low, does the exchange just collapse? Do they put up a closed for business sign?
They have emergency brakes built into the system, and we are already seeing them pump those brakes hard. The report notes that the CME, the group that runs the exchange, raised margin requirements significantly. They hiked it all the way up to $25,000 per contract in late 2025.
Okay, for the listener who doesn't actively trade commodities futures, what does raising the margin requirement actually achieve?
Think of it like a required down payment on a house. If you want to control a futures contract for 5,000 ounces of silver, you don't have to pay the full multi-$100,000 price up front. You just put down a deposit, which they call margin. By raising that required deposit to $25,000, they make it much more expensive to play the game.
Ah, so they're trying to kick out the speculators, the little guys who are just making leveraged bets on the price going up.
Exactly. They are aggressively trying to deleverage the market. They want to force the paper traders to close their positions so that the overall open interest drops. They want to shrink the number of people playing the musical chairs game before the music stops.
Did it work?
Partially. The report shows we saw open interest drop by about 9,500 contracts in mid-February, so some weaker hands definitely got shaken out of the market.
But that feels like a total Band-Aid. Raising the cost of a paper bet in New York doesn't magically create more physical silver for a solar panel factory in Texas?
It doesn't at all. It just buys the exchange a little bit of time. It cools the casino down, but it doesn't fill the pantry. The industrial demand is physical and real, and it's not going away just because the CME changed some trading rules. The solar factories still absolutely need the silver paste. The AI data centers still need the connectors.
And our report specifically mentions the month of March. Why is everyone so focused on watching March?
March is a major delivery month on the futures calendar. It's when a huge chunk of these contracts expire and actually settle. February is usually a quiet off-cycle month, and yet we still saw record demand for physical delivery. So the deep fear in the market is that when March hits, the flood of requests for physical delivery might completely overwhelm whatever is left of that registered stock.
What is the absolute worst-case scenario here? Let's say I'm a manufacturer. I bought a contract. I want my silver delivered to keep my factory running. And the COMEX looks at the vault and says, sorry, we're empty.
The exchange does have a built-in escape hatch, a clause for force majeure or forced cash settlement. They can essentially say, sorry, we don't have the physical metal. Here is a check for the cash equivalent instead.
But that is a complete disaster for an end user. If I need physical silver to build a missile guidance system or a solar array, I can't melt down a paper check.
Exactly. A check from the CME doesn't conduct electricity. If forced cash settlement happens on a large scale, it shatters the trust in the COMEX as a reliable price discovery mechanism. It proves to the world that the price flashing on the screen isn't real because you can't actually buy the physical metal for that price when you need it.
And if that trust breaks, the global pricing power likely shifts permanently over to Shanghai.
Because that's where the physical metal actually is. It's a massive geopolitical shift in gravity.
It connects right back to something you said earlier about the invisible nervous system. It really feels like we are watching a massive realignment of global economic power, just being played out entirely through bars of silver.
We absolutely are. It's pure geopolitics now. If China controls the refining capacity and is willing to pay the true higher price for the physical metal, they essentially control the supply chain for all the technologies of the future. Meanwhile, the West is left trading paper receipts back and forth for metal that isn't actually in the vault anymore.
It's really a sobering thought for anyone paying attention. We are so used to thinking of the modern economy as just numbers on a screen or software in the cloud. But this deep dive really reminds us that at the very bottom of the tech stack, there are actual physical things, atoms, that we are simply running out of.
We are hitting the hard physical limits of the green and digital transition. We think of the cloud as ethereal and solar energy as infinite, but they are built on highly finite materials. Silver is becoming the primary bottleneck. You can have all the political will in the world for green energy, but if you don't have the silver, you do not have the solar panels.
So for the listener sitting at home wondering what to do with all this information, it's not just about commodity trading. It's about fundamentally understanding the physical constraints of the next decade of human progress.
Absolutely. The takeaway is to watch the vault numbers in New York, watch the delivery numbers when March rolls around. If those registered numbers keep dropping towards zero, we are going to see real fireworks in the market. We are watching a historic resource squeeze play out in real time.
And here's a final thought to leave you with, something to maybe chew on after the show. If the West loses control of silver pricing, because we were busy trading paper while the East was aggressively hoarding the actual metal prive, what other critical resources are we totally mispricing right now? Is silver just the canary in the coal mine for a much larger global resource crisis?
That is exactly the question that keeps me up at night. If the paper price doesn't reflect physical reality, eventually reality crashes the party.
Well, on that cheerful note, we will definitely keep watching the vaults for you. Thanks for joining us for this deep dive. Stay curious, and we'll catch you next time.